Everyone assumes a 790 credit score is the magic key to the housing market. You probably picture lenders falling over themselves to offer you their best rates, right? But what if I told you that even with a near-perfect score, you can still get a no? It happens more than you think. We're going to break down what doors that number actually opens, and what hidden barriers it can't do a thing about. It turns out, a high score isn't a golden ticket. It's just the price of admission. Let's be clear. Having a 790 credit score is a huge advantage. It puts you in the top tier of borrowers, and lenders definitely see you as a low-risk applicant. You'll almost certainly be offered the best available interest rates, which can save you tens of thousands over the life of your loan. For a conventional loan, the minimum score is usually around 620, so 790 clears that hurdle easily. This is where the journey for many top-tier borrowers begins. With a 790 score, you can get pre-approved almost instantly. On paper, everything looks perfect. You'll have your pick of almost any loan program, conventional, FHA, you name it, and will be set to lock in one of the best rates on the market, which in mid-2025 is in the high 6% to low 7% range for top-tier borrowers. The doors are open and the red carpet is out. This is the part of the story everyone expects. The first sign of trouble often has nothing to do with a credit score. It comes from the next line on the application, the debt-to-income ratio, or DTI. This is just how lenders measure how much of your monthly income is already spoken for by other debts. A borrower can have a great income and a stellar credit score, but also have a car loan and some lingering student debt. When the lender crunches the numbers, the DTI, including the new mortgage, might clock in at 48%. Now, while some programs are more flexible, many conventional lenders want to see a DTI of 43% or less to offer their absolute best terms. Suddenly, that 790 score isn't a magic wand. It can't just erase the math. The lender will explain that while the credit history is perfect, the applicant's cash flow is too tied up. Their borrowing power is simply less than they thought. The perfect score has just met its most common opponent, real-world debt. The fix for a high DTI problem can be simple, but it isn't easy. It might mean paying off a car loan completely. This could involve using a big chunk of the cash saved for a down payment and closing costs. But as soon as that problem is solved, another one can pop up. The underwriter, that's the person who gives the final yes or no, starts digging into employment history. An applicant may have switched jobs about 6 months earlier. Even if it was a promotion with a bigger salary, the lender might flag it as a potential lack of stability. They'll start asking for more documentation, extra pay stubs, and a formal letter from the new boss. This is the part of the process that trips up so many people. Your credit score gets you in the door, but the underwriter is paid to scrutinize everything else: your income stability, your assets, and where every penny of your down payment came from. They're looking for a consistent 2-year history, and any recent changes can become a major snag. A 790 score can't speed this up one bit. The application can get stuck in underwriting limbo while every last detail is verified. So after all that, can a borrower in this situation get the house? Yes. After providing all the extra paperwork, they can finally get an approval and buy a home. But the whole experience teaches a critical lesson. A 790 credit score is incredibly powerful. It gets you the best interest rate your financial picture can justify and gives you far more options. But it's not a substitute for a low debt-to-income ratio, a stable employment history, or having enough cash for the down payment and reserves. The credit score is just one pillar of the application. The underwriting process is designed to test the strength of all the others. So, can you buy a house with a 790 credit score? Of course. But the real question is, what else are you bringing to the table? Your score is the opening argument, but your income, debts, and assets are what will ultimately win the case.